Sow Good Inc. is a U.S.-based consumer packaged goods company that pioneered the freeze-dried candy category. Since commencing commercial sales in the first quarter of 2023, Sow Good developed and scaled a proprietary freeze-drying manufacturing operation dedicated to transforming traditional candy and snacks into novel, intensely flavorful treats it markets under the hyper-dried, hyper-crunchy, hyper-flavorful brand positioning. On December 30th, 2025, the company completed a series of strategic transactions that fundamentally changed the nature of its operations. The company sold substantially all of its manufacturing assets, including 6 proprietary freeze-drying machines and other property and equipment, with an aggregate net book value of approximately $10 million to Tria Grove, LLC, a related party, for total consideration of $1.5 million. Concurrently, the company entered into a distribution agreement with Tria Grove, LLC, pursuant to which Tria Grove serves as the primary worldwide distributor of Sow Good's remaining finished goods inventory, with the company receiving 10% of gross receipts from customer sales. The distribution agreement has a term through July 31st, 2026. Additionally, the company completed a $3.0 million convertible preferred stock offering, the proceeds of which were used to pay down debt and for operational purposes. On December 31st, 2025, the company entered into a securities purchase agreement with David Lazar for the private placement of 2 tranches of convertible preferred stock. The company completed the sale of the first tranche by issuing 1,500,000 shares of Series AA preferred stock with proceeds to the company of $3 million, which were used to pay down debt, reduce headcount, and for operational purposes. Pursuant to the securities purchase agreement, the company expects to consummate the sale of the second tranche with the issuance of 1,500,000 shares of Series AAA preferred stock for additional proceeds of $3 million on March 31st, 2026. The terms of the Series AAA preferred stock are substantially similar to the terms of the Series AA preferred stock, except that the Series AAA preferred stock are redeemable at a price of $200 per share. 2. Each share of Series AA preferred stock is initially convertible into 14 shares of common stock, where each share of Series AAA preferred stock is initially convertible into 250 shares of common stock, subject to adjustment as provided in the Series AAA Certificate of Designations. And 3. There is no ownership limitation upon conversion. In connection with the private placement, the company experienced a leadership transition, with Claudia Goldfarb stepping down as Chief Executive Officer while remaining with the company as Chief Operating Officer and a member of the company's Board of Directors, the Board. 2 members of the board, Chris Ludeman and Joe Mueller, resigning from the board in connection with the private placement and strategic asset sale. 3. David Lazar being appointed Chief Executive Officer and elected to the board, serving as the board's chairman, and David Naton being elected to the board and serving as Audit Committee Chairman, following Mr. Ludeman's resignation. On May 31st, 2026, upon the issuance of the Series AAA preferred stock, holders of 1,122,609 shares of the Series AAA preferred stock converted their shares into 280,652,350 shares of common stock, or 18,710,150 shares of common stock after giving effect to the 15-to-1 reverse stock split. On the same date, Mr. David Lazar converted 410,000 shares of Series AA preferred stock into 5,740,000 shares of common stock, or 382,666 shares of common stock after giving effect to the 15-to-1 reverse stock split. While we observed the freeze-dried candy category experience a significant rise in popularity during 2024 and the first half of 2025, we have observed market data showing a significant decline in sales in the freeze-dried candy category toward the end of 2025. This decline could be the result of a number of factors, including the disjointed nature of freeze-dried candy providers and the variance in quality, the arrival of large multinational market entrants and their desire to reduce competition in the space, or the exhaustion of consumer appetite of freeze-dried candy. As a result of the slowdown in the market for freeze-dried candy, the company has transitioned to a capital-light model for the duration of the distribution agreement. We operate in a highly competitive industry against competitors with significantly greater financial and other resources. We have become aware of certain of our competitors using their status in the market and marketing spend to limit our current and future customers from purchasing our products or reducing our shelf space. This caused the loss of significant customers, which resulted in a significant reduction in revenue and an increase in our inventory. Our ability to keep our current customers or grow our SKU portfolio on their shelves and expand our sales with new customers will depend on our competitors' ability to leverage their market status and financial resources to limit our access to consumers and our ability to compete with these larger competitors. On April 20, 2026, SOWG Tanzania Inc., a Delaware corporation and wholly owned subsidiary of the company Delaware Corporation, and the company entered into a share purchase agreement, the Share Purchase Agreement, with Rhizon Materials Limited, an Australian unlisted public company, Rhizon, Uranex Tanzania Limited, Uranex, Magnus Technologies Tanzania Limited, Magnus Tech, and Uranex ESIP Primary Therapeutics, pursuant to which the company agreed to acquire 100% of the issued and outstanding shares. The acquisition of Uranex and Magnus Tech, each a wholly owned Tanzanian subsidiary of Rhizon, collectively the Targets. The Targets are the sole holders of the Nachu Graphite Project, an advanced stage graphite development asset located in the Ruangwa district, Lindi region of southern Tanzania, the Nachu Project. Upon closing, the company intends to focus on advancing the acquired project toward construction and production, with its current consumer products operations managed as a separate business segment, and management believes the transaction positions us as a burgeoning battery metals company with a platform for additional critical mineral acquisitions in the future. For the 3 months ended March 31st, 2026, the company recognized approximately $18,000 of commission revenue under the distribution agreement. For the 3 months ended March 31st, 2025, the company recognized no revenue. Salaries and benefits expense for the 3 months ended March 31st, 2026 was $295,000 compared to $807,000 for the 3 months ended March 31st, 2025, representing a decrease of $511,000 or 63%. The decrease was primarily attributable to reduced headcount and lower employee-related costs following the company's transition away from manufacturing operations and related workforce reductions. Professional services expense for the 3 months ended March 31st, 2026 was $1.1 million compared to $192,000 for the 3 months ended March 31st, 2025, representing an increase of $932,000 or 485%. The increase was primarily attributable to higher legal, accounting, consulting, and transaction-related expenses associated with the company's strategic transition, financing activities, and ongoing public company compliance requirements. Other general and administrative expenses for the 3 months ended March 31st, 2026 were $263,000 compared to $579,000 for the 3 months ended March 31st, 2025, representing a decrease of $315,000 or 55%. The decrease was primarily attributable to lower facilities, administrative, and overhead costs following the company's exit from its manufacturing operations and facility reductions. Interest expense for the 3 months ended March 31st, 2026 was $243,000 compared to $365,000 for the 3 months ended March 31st, 2025, representing an increase of $121,000 or 33%. The increase was primarily attributable to financing activities completed in connection with the company's transition to an asset-light operating model. On March 31st, 2026, David Lazar resigned as our Chief Executive Officer, and Donna Guy informed our board that she would be resigning as our Chief Financial Officer. Upon these resignations, our board appointed Yisroel Goldberg as our Chief Executive Officer and Chief Financial Officer. On the same date, our board accepted the resignations of Claudia Goldfarb, Ira Goldfarb, Edward Shensky, Lyle Berman, and Jeff Rubin from our board. the board elected Yisroel Goldberg, Binyamin Posen, Joseph Lebkowski, and Jack Wartzman to serve on the board effective upon those resignations. For example, on May 14, 2025, we received a letter from the staff indicating that, based upon the closing bid price of our common stock for the 30 consecutive business days, we did not meet the minimum bid price of $1 per share required for continued listing on NASDAQ pursuant to the minimum bid price rule. The letter also indicated that we will be provided with a compliance period of 180 calendar days, or until November 10, 2025, in which to regain compliance pursuant to NASDAQ Listing Rule 5810C divided by 3, in which to regain compliance pursuant to NASDAQ Listing Rule 620 Callier-Menerac Speed. On November 11, 2025, NASDAQ subsequently issued a letter providing us with an additional 180-day compliance period, or until May 11, 2026, to regain compliance. Further, on April 7, 2026, we received written notice from the Listing Qualifications Department of NASDAQ stating that, based upon the stockholders' equity reported in our Form 10-K for the period ended December 31, 2025, we were no longer in compliance with NASDAQ Listing Rule 5550B-1, which requires a company to maintain a minimum of $2,500,000 in stockholders' equity. In accordance with the NASDAQ listing rules, the company has 45 calendar days, or until May 22, 2026, to submit a plan to regain compliance.